The global macroeconomic environment is the major story. It has been since the 20th of January, since US President Donald Trump was sworn in. And as companies start reporting their second quarter or second half results, that's a big factor that they're citing, the macroeconomic environment. It's been an absolute whirlwind with trade tariffs, the Israel-Iran war that lasted 12 days. Let's take stock of the state of the global economy and the impact here at home with Sanisha Packirisamy, the chief economist at Momentum Investments. Good evening, Sanisha. Very good to have you on the show. At the center of the global economic story for the first half of the year, it's trade, whether it's threats, whether it's actual disruptions, tariffs, or demand or lack of demand.
Thank you so much for having me on your show. Indeed. So we've seen that, global trade volumes are expected to hit a stumbling block this year. And part and parcel of that is because we are seeing a far more protectionist stance being adopted by the new U.S. administration led by Donald Trump in his 2.0 term. And, if we look historically, what really buoyed emerging markets in the past couple of decades was, in fact, globalization, emerging markets becoming a bigger part of the global economy. And now with that driver being taken away, we are likely to see softer growth coming out of that particular region this year as global trade volumes take a knock.
And if we go to the war, part of the concerns that many investors and the markets had, the Straits of Hormuz, which is controlled by Iran and Oman, carrying 30% of the world's oil that's carried by the sea. There's still a fragile sense that it's a ceasefire. The war is not over. How are markets reacting to this?
I would say that markets are pretty much pricing in a base case scenario where you get, a fragile ceasefire. Overall, there's a de-escalatory trajectory, but it is a fragile ceasefire, so you can see it being breached at times, and that would be largely symbolic in nature. That means that we could, get tensions lingering on, even though we might see that direct conflict actually subsides. What I don't think the market is pricing in is renewed and intensified conflict, because that would be a worst-case scenario. So in that kind of scenario, we find that Iran closes the Strait of Hormuz, and you've just outlined how important that is for the global supply of oil and liquefied natural gas. In that kind of scenario, you'd see that Iran renews its strikes on United States and Israeli targets. We may even see in that kind of scenario that the regional infrastructure in the Gulf is targeted so as to inflict economic pain on the global economy through lower oil supplies and higher oil prices. And again, I also don't think that the market is pricing in, a very optimistic scenario, which is a prolonged ceasefire that's upheld. And in that kind of environment, we find that Israel and Iran are actually trying to resolve the underlying issues. We see that international diplomacy actually prevents regional escalation, and we actually start to see strides being made in that regard. So I would say the markets are basically pricing in that middle ground scenario of a fragile ceasefire. Peace kind of holds for now, but at times it does actually flare up and causes a bit of volatility in markets.
So a pragmatic approach there. If we look at the dollar then, economists are worried about where the US dollar's future will lie, and also Trump's big, beautiful bill, as he calls it, could add $3.2 trillion in debt to the United States.
Correct. I think this is, one of the issues that the market has become quite circumspect about the future of the US dollar. The U.S. dollar has been the world's reserve currency for a number of decades now. They were seen to be the country that had an independent central bank that had some control over its financial situation, the fiscus. And we are now in an environment where there are question marks around both. So we currently have Jerome Powell, who is heading up the Federal Reserve in the U.S., but his term does come to an end in May of 2026. There are question marks over whether or not Trump will put one of his henchmen in his place, someone that could potentially take a far more dovish approach to interest rate policy, which basically means cutting interest rates by, too much, causing a bout of inflation to come about a bit later. We've also seen that with the big, beautiful bill, that fiscal deficit is expected to grow over the next couple of years. That will add to debt to GDP. And there are some concerns around a bit of a debt trap starting to formulate in the U.S. economy. And these issues have now started to crop up and, pulled away some of the confidence that has been underlying the dollar in the last couple of decades.
I found this very interesting, away from the dollar and the dollar's dominance in the global economy, because part of the consequences of the tariff announcements was that countries have to find other ports of call. They have to find other markets. And Chinese goods are going hard. They're flooding European ports, and European container volumes from Asia are up 7%.
So we've seen, we expected that we might actually see a bit of a slowdown in trade coming out of China, given that they are still, to some extent, reliant on the U.S. market absorbing some of their goods. But essentially what we've seen is just a reorientation of trade. And so China has actually taken those goods and exported it to other markets. And I think that markets in general were a little bit concerned that we would get a continuation of Chinese disinflation to the rest of the world economy. So in other words, trying to find other markets, but then exporting those goods at a cheaper price. I think this is one of the reasons why we've seen expectations for inflation in the U.S. economy going up quite sharply, but inflation for other markets in the rest of the world not reacting in the same way because of those cheaper Chinese goods then coming into the market. We've also seen that China is starting to go through other routes, so exporting their goods to another country before those goods actually land up in the U.S. economy anyway. And I think some of that is happening, and it has actually sheltered trade for the Chinese economy to date.
Yeah, economists love to talk about unintended consequences, and that's one of those that come from tariffs, of course. And it's even possible to have foreseen what would happen. It's just gone 19 minutes before 7 here on Power Business. If you've just joined us, we're talking to Sanisha Packirisamy, the chief economist at Momentum Investments, about the global economy. If we come closer to home, Sanisha, growth forecasts are down for emerging markets, including sub-Saharan Africa, at 3.5%. Where are the pockets of growth for emerging markets?
So we are expecting that within the emerging market composite that India will continue to perform quite well. And so when we look at that Asia region, that's one of the bright spots in the global economic recovery for the year. As you've mentioned, there is quite a bit of pressure coming through for Latin America, as well as the Caribbean region. And that's because there are higher trade barriers that are now in place. And we are still continuing to see structural issues in countries like Brazil or like in Argentina. If we look at the Middle East and North Africa, this is the conflict-ridden region. And so we would expect, that inward investment would slow, tourism would also slow, and that would hamper the growth prospects of those economies. Even though we expected to see a little bit of an uplift in countries like South Africa here at home or in Nigeria, overall the sub-Saharan Africa market could still take a little bit of a knock. And so we're not expecting massive growth performance to come out of that region either.
And speaking of one emerging market in particular, South Africa, it appears that the GNU is in place for now, but we're still expecting some very lackluster growth for this year.
Indeed. So I think, with the government of national unity, we should expect it to be quite a noisy marriage between the coalition partners. But I think it's important to look through the noise. We know that at this stage of the government of national unity, they actually need each other. So it doesn't actually serve the Democratic Alliance or the African National Congress for the DA to actually leave, because I think both of their voter bases will suffer. Yeah. And so we've seen, out of the polls that are generated by the Social Research Foundation, whenever there is a bit of a dispute like there was on the value-added tax increase that was initially proposed at 2% by the ANC, that actually hurt their voter base quite a lot. And so it almost seems as though voters are looking for potential policy failures and pinning the blame onto the African National Congress. So they've got to play this game, quite carefully. We've seen that support levels for the Democratic Alliance have picked up as the GNU has progressed. And so that again indicates that, largely speaking, supporters for the DA are in support of a government of national unity. So I think, just noting that in the background there will be a fair amount of political noise. Our base case is that the GNU does hang together. On the growth front, we're seeing that a lot of that uncertainty on the political side is starting to come through in the form of weaker investment growth. And so that has actually knocked the growth forecast to date. At the start of the year, markets were looking for growth close to 1.82% for this year. And then, of course, we had, 3 budgets coming about. We had a lot of uncertainty in terms of whether the GNU would hang together or not. And on the back of that, we've seen that economists have pared back their assumptions on fixed investment. We may get a little bit of growth out of the consumer, given that inflation is coming down this year on average. And so, the real wage gains, the money you have in your pocket at the end of the month is just a little bit more. But again, on the external side for exports, we're seeing a bit of a slowdown there. And we know that government is quite constrained in terms of what they are actually able to spend without seeing a further deterioration in the fiscal deficit.
We've spoken to several analysts on power business who have agreed that now it looks like the GNU is in place and investors are feeling more certain that the GNU won't break up just yet. Do you foresee that there will be some more confidence in our government in South Africa in the second half of the year?
I think that we are going to see a little bit of confidence coming through, but I think it will be tempered. So I think we had that post-GNU formation euphoria that came through quite strongly in markets. That then faded away at the first sighting of, the GNU potentially not hanging together. And now
I think that was the Bella Bill. Yeah.
And then we saw, yes, exactly. So we had, the issues around the education bill, issues around NHI, and then we started to see, the cracks forming in the GNU. Because after all, the 2 main parties in the GNU do come from very different ideological backgrounds. And so I think it's to be expected that, when we get policy issues that come to the fore, that there will be this contention between the 2 parties. The DA needs to say things in order to appease their own political backing and base. And the same goes for the ANC. So we should almost, assume that the background is going to be quite noisy. But at the end of the day, we're heading into 2026 where there's local government elections. And we know that at local government elections, people vote for things like service delivery. They want to have electricity. They want to have running water. They don't want to see potholes on the road. And so, there has to be some middle ground between the parties within the GNU to fix those issues in order to get votes back at the local government elections.
All right. Thank you very much, Sanisha Packirisamy, the chief economist at Momentum Investments, talking to us about the global economy, what the tea leaves are reading for the United States, for emerging markets, for South Africa, back here at home.